All right, hi everyone. We're going to start the next panel soon. Just give people a second to come in, I guess. Okay, I'll just start here then with a brief introduction. I'm Melissa Karsh. I'm the editor of the Financial Regulation newsletter at Bloomberg. Guys can just kind of sit down. We'll get started. Today's panel will focus on the impact of global regulation on the FX markets and the implications of new rules for major players, cross-border considerations and product intervention by regulators. And my panelist to my right here is Paul Durham. He's a partner at Hawley Nethercote in Australia and chair of the OTC Derivatives and Forex Compliance Forum. And then we have Michael Paracci. He's of counsel in Morgan Lewis's investment and securities industry practice. We have Peter Sanchez. He's special counsel in the U.S. Commodity Futures Trading Commission's Division of Clearing and Intermediary Oversight. And then at the end, we have Jake Green. He's the senior associate in the financial regulatory group within Ashurst's corporate practice in London. So I just wanted to thank the panelists for joining me today, and thanks Shift Forex for having us. We wanted to start just kind of to take a look at the bigger picture, and I wanted to throw it to Jake and kind of ask if you could define what retail versus institutional means in the UK and Europe.
Sure. In many ways, actually, with Forex trading and derivative trading, it doesn't actually make a difference, retail or professional. In the UK and in Europe, any retail client, any man on the street is free to trade FX, spread bet, derivatives, providing its execution only. These rules are European rules. They come in from the MiFID directive and regulation. A second set of MiFID rules will come in over the next couple of years, we expect. But in many ways, on this topic, it doesn't matter if we talk about retail or professional. That said, I think our professional level is probably slightly lower than the US professional level, especially because we also have an elective professional client, which could almost be me if I traded a bit more, had a slightly higher net worth, or worked in the financial sector. And actually, being a lawyer, you're in the financial sector, so I'd tick that box. Providing I made a certain amount of transactions a year, that would be fine. Or if I had a slightly higher net worth than I do, although not a massive net worth, about €500,000 euros in liquid assets, that would see me being a professional client. But as I said, it's not the most important topic in relation to derivative trading on an execution-only basis.
Okay, and Peter, what about in the U.S.? Is that something different?
Sure. Before I start, I have to say that the views I express are my own. They don't represent that of the chairman or the commission. So I won't be fired tomorrow because I've said that, and now I can talk. So retail and institutional is regulated very differently. And when I say retail customer, it's for an individual, someone with up to $10 million. And there's a regime in place for that. And for over 10 million, it would be under the Dodd Frank rules for swaps. And those are still evolving, but there's some stuff there now that applies currently. And if we want to talk about the retail side, I think a little bit of the history is helpful to understand that. So when the commission was formed in the 70s, it was regulating agricultural commodities. And when the act was passed that formed the CFTC, the Congressional Committee got a letter from the Department of Treasury asking them to exempt the interbank Forex market from the requirement that all commodities be traded on an exchange. So there had been forever this interbank market for banks and large multinational corporations to trade currency back and forth, and they didn't want this agricultural regulator involved in it. So that was put into the act, and it wasn't intended to apply to retail customers. However, over time, people started trying to market it to retail customers, and the commission took action. And eventually, some case law went against the commission. And one case that went to the Supreme Court actually said that if it's on an exchange, the commission has jurisdiction. And if it's off an exchange, it's completely unregulated. So Congress scrambled to get something in place. And in 2000, there was an act passed called the Commodity Futures Modernization Act of 2000, which gave the commission anti-fraud jurisdiction, but not any other kind of jurisdiction. So we couldn't require registration for most of these parties. And there were two types of people that began marketing Forex to retail customers. There were the people that saw it as a business and wanted to grow it. And then you had the people that were banned from the securities side or from futures side for fraud, and they couldn't get a job doing anything else. So there was this strange dichotomy. The business started to grow, but eventually there were a couple more cases that went against the commission. Zellner case in the 7th Circuit and Erskine in, I think, the 6th Circuit, which said that the spot Forex market was out of the commission's jurisdiction. And as a result of that case, the act was amended again, and a new section was added, which gave the commission authority to completely regulate this area. And as a result of that, some rules were drafted which covered the retail Forex market. The draft rules were a lot harsher than the final rules. They limited leverage to 10 to 1 and required a lot of other things that didn't make it into the final rule. But because they were so controversial, we received thousands of comment letters. It was the second most comment letters that they'd ever gotten, and the rule sat on the shelf for a while. But during the passage of Dodd Frank, there was a clause inserted that the commission had 90 days to finalize their retail Forex rules, which they did. And for other regulators, banks, broker-dealers, their primary regulators had a year to draft rules, which they did. The SEC put rules in place, and the OCC for the banks and FDIC put rules in place for retail Forex. Should I talk about institutional or?
Well, maybe, and you touched upon, some of the Dodd Frank rules. So I wanted to, maybe throw it to Michael and talk about kind of what's going on currently, and has activity in the U.S. foreign exchange market slowed down due to the increased regulation, specifically Dodd Frank, as some have predicted?
Yeah, no, I think absolutely. We heard from the panels earlier today that has certainly been effective. Not just Dodd Frank, but some of the stuff Peter was talking about and the retail rules. I mean, one of the difficulties facing anyone in this sector that's going to be working in the U.S. is the fact that the regulators still take a dim view of Forex, and in particular retail Forex. And even in light of the amendment to what the definition of retail is, as Peter mentioned and Jake suggested, you can be pretty wealthy and still be considered retail. You can be pretty sophisticated from the types of investments you have and be a professional investment manager and still be considered retail. So it definitely has affected the business in the U.S. And people's appetite for continuing to do the business in the U.S. I know the panel on M&A activity, the one attorney suggested that just going public increase. You're looking at $1 million, $1.5 million for compliance. I don't think that's an unreasonable number. I mean, obviously he was talking about a lot of the SEC filings, the 10Ks, and other things that are required for a public company. But just if you're a Forex dealer, the type of compliance infrastructure you need to have in place is going to be very expensive. With Dodd Frank, as Peter pointed out, you now have a bifurcated regulatory scheme. So what we're seeing are a lot of the players in the retail segment here in the U.S. are now also being forced to register as swap dealers, because again, their clients are more than just individual traders. And what they're facing is the fact that your Dodd-Frank, your activities with your institutional are going to be considered swaps under Dodd-Frank, and you're going to be subject to all the Dodd-Frank requirements, the suitability, the institutional suitability, which mean things like the ISDA protocol, having to do real-time and regulatory reporting, additional record-keeping requirements. And I think the most difficult aspect of that is you're going to have to really have two systems set up, so that when you're you're dealing with retail, non-retail, you have to know which system it gets sent through. One of the big issues that I don't think frankly has not been addressed by the regulators is what happens when you have a customer who on Monday is retail because his investable assets are $9.5 million. Thursday, he's up over $10.1 million, and now he's an institutional, and magically the same trade he did on Monday, on Thursday is now a swap, and it has to be treated differently. Like I said, I don't know that the regulators have really, and I'm not just looking at you, Peter, have really addressed how to handle that. And I don't know that there's a good answer from either a regulatory standpoint or a business standpoint on which way works better.
Okay. Well, I wanted to ask Paul what's the difference in Australia, with the regulation and the institutional versus retail?
Sure. It's pretty simple in Australia. It doesn't matter if the clients that you deal with are retail or institutional, you need a license. Unless you fall within the narrow exemptions, which generally apply to if you're overseas and you only deal with the institutionals in Australia, you might get out of needing a license, but everyone else needs a license. The way that retail and institutional is split is it's called wholesale clients, and the regulation in Australia, 80% of it sits in the retail space, and that's just increasing. Even at the moment, this year, there's been a whole lot of new laws that have come in to ban conflicted remuneration. And so what that means is any benefit that's in connection with it that could reasonably be expected to influence advice given to a retail client. So imagine an introducing broker. The introducing broker is getting a percentage of volume, some sort of spread for the amount of volume that they get to the platform. That would be considered banned conflicted remuneration, so those structures are all having to change. So that's just one example. To be a retail client in Australia, I think it is maybe a bit easier than the other jurisdictions to switch that person to a wholesale client. There's a provision that we call the deeming provision. A licensee can deem an individual to be wholesale if they get the individual to sign a letter, and it says things like, you understand you won't get all the traditional disclosure documents that you're entitled to. We think you're sophisticated because you have these characteristics. Client signs a letter, you get it back, you can treat them as wholesale. And that means a whole range of provisions won't apply to how you deal with that person. The risk with that provision is that if the person that you've deemed to be wholesale makes a complaint, then you have to prove after the fact why you thought they were wholesale. So, there's a double-edged sword.
Okay, and we heard a little bit about what's going on with Dodd Frank, and so Jeek, I was wondering what's the status, of rules on, OTC derivatives and swaps in the UK and Europe. I know, EMIR and that
so
nature.
the European equivalent is EMIR, and we are behind the curve against the US of the regulations coming into force. Actually, some of the technical standards, the first set, I think, came into force a couple of days ago, but on the ground there are going to be very few changes for the next couple of months, maybe even 12 months to 18 months. My clients in the industry tell me that Dodd-Frank's having major changes to the way they will do things. In many ways, EMIR won't have such a major impact in Europe compared to Dodd-Frank, but we are certainly behind the curve on that one. Okay, and
Paul, will derivatives regulation in Australia have a similar impact, or is that?
Not as significant as in the US or in Europe, but we already have a licensing regime where like I was saying before, if you provide a financial service in Australia, which is quite broadly defined, you need to have a licence. So some of the requirements that are flowing down from, I guess, the G20 level, which deal with trade reporting, central counterparties and things like that, they are filtering down into the Australian jurisdiction like they are with all the other countries, and so we're all dealing with the same stuff on those topics. And I think Australia has, well, everyone was meant to have these frameworks in place by the end of last year. I think Australia has the framework in place where it is given powers to the right bodies to create rules around trade reporting, central counterparties, certain markets, electronic markets, etc. But we haven't done anything yet. So I think the commentary is all the industry is lobbying government in Australia to say, just make sure the reporting requirements and the types of products that are caught by these central counterparty requirements, etc., are the same as best as they can with the other jurisdictions, because, I mean, most of you sitting in your chairs will represent a business that has operations in many different countries. You don't want to be reporting the same stuff to different regulators, and so I think Australia's waiting to see what the US is going to do and before it decides to make a decision. So practically nothing's happened with that new tranche of legislation yet.
Okay.
I don't know that I would suggest that any jurisdiction should follow what we're doing if the implementation of Dodd Frank, except for anything Peter's worked on. But other than that, it's been, I think, you know, the effect, we talk about the effect that Dodd Frank is having, and we're seeing it already with certain reporting and clearing requirements have gone in place in the last 2 to 3 months. Because of the tremendous amount of uncertainty in how these rules apply to existing business structures, there have been issues with the reporting. There's questions on whether or not things are being over-reported, under-reported. I can tell you a day doesn't go by that I don't get a question on, you know, I called two very sophisticated entities. One says we have to report this way. The other one says no, we report it this way. They all have, you know, extremely smart and experienced outside counsel. No one's sure how to do it. One of the things that we found, if you look near the end of last year, when all this was supposed to start clicking in place, on one day alone in December, the CFTC issued, I believe it was 16 no-action letters. It seems to me, at the risk of never being hired by the CFTC again, it seems to me that if you need to issue that many no-action letters, approximately 3 days or a week before your rules go into place, the rules in the first place weren't going to work.
I think that's quite interesting because the FSA has actually had a different kind of approach over the last couple of years, and it will be even more aggressive moving forward as it changes to the FCA in about 2 weeks' time. But we had one client who actually had a transaction, had a suspected case of market abuse with one of their clients who was clearly doing a big case of insider dealing. Phoned up the regulator and reported it properly, and the regulator said, thanks for that. They said, oh, by the way, we can't see your trade report in relation to the underlying transaction, and they'd reported the derivative wrongly. And so they said, we can't see your trade report, thanks for letting us know, yep, it was insider dealing, but we're fining you £500,000 because you've also let us know that you didn't report it clearly. So, I mean, it just goes to show the kind of attitude you've got coming out of the FSA at the moment on things like that, and that's going to continue, I'm afraid to say.
Peter, did you have any thoughts on that?
Yeah, I think a lot of the frustration with Dodd Frank is that it was put in place and there was a deadline involved, and so there were lots of rules going on in parallel, and there was not great coordination. So certain rules were finished before other rules were in place. So for instance, business conduct standards was done before there was a definition of swap dealer. So you didn't know if these rules were going to apply to you, so you didn't know if you should write in a comment letter. Also these rules apply to all swaps, and most of the experience of people in in the legal bar and especially in the CFTC deal with things other than Forex. So certain issues that are unique to Forex don't really come up. So the reporting kicked in, I believe, on February 28th. And there are certain ways that Forex is structured, for instance, like a rolling spot transaction. Do you report that every 2 days when it rolls over, or do you report that as one swap? And that might not seem like a big deal, but if you're trying to not be a swap dealer and you're going to do less than $8 billion so that you would not trip that requirement to register as a swap dealer, that would make a difference if you report it every 2 days or as one transaction. And it's very easy for someone to get tripped up and have to register as a swap dealer because unlike other swaps, the notional values on Forex are so large that you can very easily trip that 8 billion mark.
Yeah, I think it's a very good point, and actually a great example of not only the problems for people trying to do business in this area, but also for what is one of the claimed purposes of Dodd Frank, to bring transparency to the markets. Well, as you point out, if I'm reporting a new trade every 2 days, what is that going to make it look like, the size of the market? How do you report it? Is it closed and it open? And the supposed transparency that many seem to feel is going to be a panacea for the public, and I think Chairman Gensler is that's what he keeps trumping every time he's in front of an audience, the transparency this reporting brings. If the information you're getting is inaccurate or perhaps not easily understood, I don't know that the transparency in and of itself is a net positive.
Okay, and I know, Jake, you were mentioning the FSA, FCA, and on product intervention, it seems regulators in UK and Europe and in Australia too have taken a more active role in banning products or methods in which they are sold. I mean, do you have any recent examples of
that? I think so. On the 1st of April, the FSA, the Financial Services Authority, becomes the Financial Conduct Authority. It was actually going to be called, I need to get this right because it was dropped very early, the Consumer Protection Markets Authority. And therefore it is very consumer facing, very consumer focused. One of its biggest mandates is product intervention. It will intervene where it sees there as being a problem and a possible detriment to clients. And even before the date of it coming in 2 weeks' time, we've seen examples of the FSA issue warnings about products or stopping firms from selling products where they just don't think they are in the customer's interest, and forcing major banks to issue undertakings not to rely on certain client terms that are deemed to be unfair, be it cancellation terms or indemnities that a man on the street might not understand. So these are really important issues that are going to change the way products can be sold in the UK, but there's just not much certainty about what they will do.
Okay. And Paul, did you have any thoughts on that?
Yes. There's about 46 licensed margin Forex / OTC derivatives businesses in Australia, and ASIC, which is a government regulator, last year conducted surveillance on all of them. Like what you said, the government doesn't look fondly on the retail FX sector generally, in our experience. It tends to see the bad activities of the few and, generalise. But so they conducted surveillance last year on everyone, and that was really to do with how client money positions are being held and how they're being reconciled. So they're doing that again this year. So in that space, the regulator is very active. There's 3 recent examples where they've taken action against derivatives dealers. One was against a derivatives dealer in the Gold Coast, which is a popular holiday destination in Australia, but it's also known as being a place where there's a lot of wealth creation experts who get in trouble. And this guy was called Aussie Rob, and he ran a business, a derivatives trading business, and I wrote down what he was promising. It didn't sound that bad. He was just saying that options trading can help you generate wealth. But then he went to say options trading is easy, option being a type of derivative in Australia, And then he went on to promise returns of 5 to 10% per month, which is obviously ridiculous. But anyway, so he was shut down. There's no surprises to anyone here. But maybe a less severe example would be another business that had its license cancelled. So again, the regulator coming in, using its administrative powers to intervene in the derivatives space. This business was called Camelot Securities, and it said things on its website. And if you've got a website, I wonder if any of you would say anything like this. But the website said clients have generated significant returns through trading derivatives with us. And they also said on their website, clients could generate, or you could generate, or have an expectation of generating significant returns by following our trading strategies. And in actual fact, they had a really high commission structure in that business, the Camelot business, and a lot of their clients had actually lost a lot of money, and so the regulator said that's misleading and deceptive and banned them from running their business. The third example, which is less severe again, would be City Index. They got in trouble in Australia because they made statements on their website about trust money being fully protected. If any of you have followed MF Global's collapse, you'll know that depending on where the money was sitting at the time of insolvency would depend on whether it's classified as client money or not, which would depend on who gets the money. Does the client get their money back or not? And so City Index on their website said things like, your money will be held on trust for you at all times. In Australia, you can use client money and place it with hedging counterparties, so that's actually not legally correct. So they were fined as a result of that. There was some infringement notices as well. And so they were fined $13,000. So it was a slap on the wrist. But it was an example of how the regulators really trawling. It's got limited resources, so it's trawling through websites as one of its first points of call. And it's looking at statements, misleading, deceptive stuff. They're getting really active.
Okay, and before I throw it to, I wanted to see if there was anyone in the audience that had any questions. Someone back there.
So I think I can speak loudly enough. So for the gentleman from the U.S. there, transparency, and you noted the chairman again sort of saying, we want to make this more transparent. Is there a metric for measuring any tangible benefit?
In my view, no. They haven't had one. And in fact, I mean, that has been the way in which both SEC and CFTC have recently lost significant challenges to their rules. In that, and I understand you're asking about measuring the benefit of the transparency, but just I think the broader issue of these rules in place. So the CFTC lost on these position limits they put in place because through an attack on a lack of a cost-benefit analysis. The decision, to be a bit pedantic about it, the decision actually wasn't specifically on the cost-benefit analysis. It actually was on a more nuanced legal approach. But that was the argument they were making, similar to the SEC lost almost 2 years ago now on the broker-dealer investment advisor distinction. And I have not seen anything that measures the benefit of it. I think if you just look, you can go to the DTCC website, and they have, real-time reporting, live feeds, and it'll show you these positions and the different trades, I should say, that are being put on. And there's no doubt in my mind there are people, I'm sure many here, who can look at it and glean important information from it, which does serve a purpose. I don't mean to suggest that these don't serve any purpose, but whether or not they serve a broader benefit to the markets and consumers, particularly when we start talking about retail consumers, I question whether that's true. I have not seen any discussion of how they're going to measure whether there is a benefit to it. Presumptively, you would hope at one point someone will produce some paper, and depending on which side of the argument they're on, will probably determine how they come out on the issue. Like I said, from an anecdotal aspect, I like to think that I'm a relatively intelligent person. I go on and I'll look at some of these. I don't know that I'm gathering much from them, but like I said, I don't know if Peter, you
Peter, yeah.
have something.
Well, not as an economist, as a lawyer, I'm not really qualified to speak about quantifying the amount of benefits. What's always touted as a benefit of transparency is price discovery and other things like that. But whether you can assign a dollar figure to it, that's something that an economist would have to do. And
I mean, I think the interesting thing about that is I don't know that anyone could really argue with a straight face that price discovery in the Forex market has been particularly difficult, at least in the major currencies. We heard earlier about the compression of spreads, and I mean there's this is $1 trillion market, and in the 14 years that I've been practicing law, the amount of information that is, available through market sources about this market has just exploded exponentially. Like I said, I don't know that there really was a price discovery concern. I know Peter very well. Don't mean it as an attack on what you said, Peter. I know that is one of the stated purposes of it, but I just don't question whether that really was a concern. I think it is more along the lines of Forex is being swept up into Dodd-Frank, and it really wasn't an area that led to the need for Dodd-Frank. If we accept the premise there was a need for Dodd-Frank.
right, a lot of the other markets where swaps are traded are a lot more opaque than Forex ever was.
Absolutely.
Okay, were there any other audience questions? I've got a couple over here.
We are an FX-only fund of funds, so as part of what I do, I talk to a lot of FX managers. And the vast majority of them don't really have a problem with the new regulatory requirements, particularly in terms of reporting, despite adding a layer of cost. What their question is, what does the CFTC or the SEC or the FSA, for that matter, what do they do with this massive amount of data they receive all the time? Besides fining you like 500,000 pounds for misreporting your derivative trades, if you report them correctly, what are they going to do with that data?
Jake, do you want to take this?
Well, the FSA angle on data is their stated objective is in relation to market abuse, and secondly, first, market abuse, and on the same level, to try to view systemic trends to spot any possible, and this will actually be not the FCA but the prudential regulator, the PRA, to spot any big systemic issues that might cause another crash. That's their stated objectives. I'm not sure whether or not they have the capacity to be able to do that.
Peter?
Well, as part of the passage of Dodd-Frank, they looked at the causes of the 2008 crisis, and I think one of the objectives, and whether they carried it out effectively or not, that's to be seen. But they wanted regulators to know who has positions in what markets, so that they could spot a problem early on.
Okay.
But are they actually comparing? I can imagine, well, the data, they're comparing what the position was from one day to the next.
Well, I think they actually might be in Europe. There's a separate directive called the Alternative Investment Fund Managers Directive, which is a management directive, and that's coming into force actually in a couple of months. And the regulators are being tasked with sharing the information and comparing it from quarter to quarter to try to do something about it. Again, I've got no view as to whether they've got the ability, but this is something that in Europe anyway they are being tasked with doing.
So on the regulatory side, the reporting rules only kicked in on the 28th of February, so I don't know in that time what they've done with it. I know that historically the reports we get, we have two groups of people who look at it. One are the economists who look for market manipulation, and then we have the risk-based people who look at net capital and things like that, and they perform tests with SPAN and Spark and their different risk-based metrics to see where a problem could arise if there's a massive market movement. But that's what the exchange-traded side. As I said, with the derivative side, reporting has just started happening, so I don't know what they've done with that information yet.
Okay, and we have another question, yeah.
So my question is, there's been a lot of talk about swaps. When the final definition of a swap that was published in the Federal Register on August 12th did not include any mention regarding rolling spot contracts. Why is there a lot of discussion that rolling spot contract might be deemed to be a swap, and what's the basis for it?
Peter, are you okay with that one?
Sure. As I said, the rules apply to all swaps, and Forex isn't usually in the forefront of most of the regulators' minds. So I think the rolling spot would fall under the non-deliverable forward, which is mentioned in the definition. And actually, when Michael said that the Forex market is bifurcated, it's actually trifurcated, because we like to complicate things in the U.S. So with regard to the institutional side, the swaps, there was another Treasury amendment. So as part of Dodd Frank, there was language inserted that if the Treasury made certain determinations, a large group of Forex swaps would be carved out of most of the Dodd Frank regulations. The only two that would still pertain to them are the reporting and the external business conduct standards. So the stuff regarding disclosure of risk, daily mark, anti-fraud, things like that. And why that's important is if you're only doing this kind of swap where Treasury has exempted it, and that's where the physical is exchanged, that doesn't count towards your $8 billion. So you can do as much of it as you want, and you'll never be a swap dealer. If there isn't a principal exchange, that's stuff that wasn't carved out by Treasury. And actually, somebody in a comment letter mentioned non-deliverable forwards, and Treasury said, no, we think that should be subject to the full panoply of Dodd-Frank regulations, which would include net capital and registration as a swap dealer. So I think rolling spot would fall under the non-deliverable forward.
Okay.
Yeah, I think the rolling spot, as Peter pointed out, is if you look, and this is, I mean, Dodd-Frank is the Full Employment for Attorneys Act for sure, because if you look at the Treasury exemption, determination, I should say, they, in the way they discuss it in there is they discuss the fact that Forex swaps and the Forex forwards involve an actual exchange of the subject currencies. Treasury does state that you can use CLS netting and netting it down, but I think there are many people are reading it in different ways, but I think it's starting to coalesce that the reading that people are taking is that there still, at the end of the day, has to be an actual exchange of the two currencies. And it can't result in a netting and settlement in one reference currency. And in the Treasury determination, they they specifically note that they're not excluding transactions where there is not an actual exchange of the two currencies, and then point to the Federal Register release you referenced, the swaps definition, and a footnote within that Federal Register release that talks about the characterization of calling something a spot or foreign exchange forward, but the actual settlement in a single reference currency.
Okay, thanks. And I know we have another question over there, I think, do we still? While you're heading over there, I wanted to throw it to Paul. And, is there a different definition of swaps in the Australian markets? Is that viewed differently as far as regulation is concerned?
Yeah, in Australia, it's really simple. There's one definition of a derivative. It's pretty much if there's an agreement which derives its value from an underlying asset, commodity, currency, or thing. Which is valued at a later time, and later time could be 2 days or more later.
Okay.
And so it's very simple. Most of these products would be considered derivatives.
Okay. And so the question over there?
Yeah, question for Peter, perhaps Michael, you might have an opinion on it as well, is there's been a lot of work from the CFTC and the NFA on the retail front over the last 10 years big gap right now in client money protection. Opinion on when we might see some type of Seg Funds rules system for the retail space and FX?
I actually know the answer to this, but if you want to.
Well, if you know the answer, I want to hear it. I'm going to go out and put a client flash right after you tell me. So.
All right. Well, in order for there to be Forex funds in Seg funds, you would need a change by Congress. So currently under the bankruptcy code, there's preferential protection for funds that are in Seg funds, and you can't put non-Seg funds in that account. So because of the way that Forex is structured, they're principal-to-principal transactions. There's a different section of the bankruptcy code which talks about how those are settled, principal-to-principal transactions. So even if you would, the CFTC would allow you to put them in Seg funds, they wouldn't have any protection. So a bankruptcy judge could say, no, these are principal-to-principal funds. I don't care where you put them. You don't get any protection. So putting them in Seg funds wouldn't help you. The only way that you would help is if Congress changed the bankruptcy code to give them preferential treatment, and then you could put it in Seg funds and it would get preferential treatment. But the way the bankruptcy code is now, it wouldn't help no matter where you put it.
Okay.
The good news is the CFTC is up for renewal this year. So if you have anyone up on the Hill, as Peter points out, it's something that really has to come from Congress and legislation first. Yeah.
Yeah, and we've heard that comment before, that Forex funds should be protected. But, as I said, without a congressional change in the bankruptcy code, there's nothing we can do. But the way that the CFTC, the Commodity Exchange Act is structured, the CFTC has to get reauthorized every 5 years. So every 5 years you get another bite at the apple to lobby Congress and get them to change that. So your chance is coming up again.
Okay.
And I will say I have heard, I'm sorry.
Mike, we're almost out of time.
No, there has been groups in the industry that I know have spoken to people on the Hill. Where those are, and I'm not sure.
I just wanted to throw one last question out there. We just have one short answer, and I know as we've discussed, each region's regulations vary. I mean, do you guys foresee any possibility of harmonizing or reaching some kind of consistency on these rules in the future? I know, Jake, if you have a thought on that?
In Europe, there's MiFID harmonised all the European rules. A client on Saturday morning asked me to find out the answer to the same question, 12 jurisdictions. 6 of them were European. Of the 6 of them, there were 4 different answers. So, no, I don't, basically.
Does anyone else, real quick? No?
Well, it's one of the stated objectives of the G20 to reduce the regulatory arbitrage that goes on. And again, like I said before, every business that has offices all over in different countries, they're all lobbying for this. But I agree. The reality is, they're all going to be different.
Okay, and I think we're out of time with that question. So I know there were a bunch of questions from the audience. Sorry we couldn't get to them all, but I'm sure we'll be around after. And I just want to thank the panelists for participating, and thank you guys for listening.